Welcome. I'm Chris Grisanti, the Chief Market Strategist at MAI Capital Management. And I'm joined in our Talking Shop segment, as usual, by our Chief Investment Officer, Kurt Nye. A special guest star also joins us today, Alex Shahidi, the Co-Chief Investment Officer of Evoke Advisors. As the market has just finished its third straight year of double-digit performance, I wanted to focus on a question that's on our client minds and also on our minds as investment specialists. How do you invest in a market that's gotten awfully expensive? I would argue that investing for a lifetime is like running a marathon. And to be successful, you need a good race plan. That's especially true in an expensive market when the risk is dialed up because you're investing at higher asset valuations. So, after managing money for more than 35 years, I've developed a three-pronged plan for navigating an expensive market. I'll go through the three prongs quickly, but we'll talk at length about each one. First, you stay invested. Second, you stay unpopular, and we'll discuss what that means. And finally, you stay with your race plan. So let's unpack that first one. First, you stay invested. The longer I've been at this, the more I appreciate that no one can time the market. Valuations, as we've just discussed, are historically high, but they can stay that way for years. And for that reason, I would not use high valuations as an excuse to sit on the sidelines in cash. But that doesn't mean we continue to buy everything and anything. So let's talk about that for a minute. Kurt, I know intuitively you agree with me that you can't time the market.
Absolutely, Chris. A core tenet of MAI's investment philosophy is that we are long-term investors, precisely because market timing is so incredibly difficult on a pre-tax basis, let alone on a post-tax basis. And as one example of that, we go back to the late 90s or even the mid-90s, where in late 1996, Alan Greenspan gave this famous speech around market valuations. And he coined the term irrational exuberance, citing high valuations in the markets. Now we know what happened after that. The market went on an incredible run through the late 90s. Ultimately, there was a pullback, but you would have missed the entire incredible run had you said, wow, the Federal Reserve Chairman is saying markets are irrationally exuberant. I need to get out.
I think that's doubly true in a market where folks are scared and so they think they can do it. So I would urge investors to be careful that they think they have the crystal ball, because the longer you do this, ironically, the more we know we don't have a crystal ball. I'm sure that's been your experience too, Alex.
Absolutely. And we also know the power of compounding. The reason rule number one is stay invested is because you can benefit from the power of compounding through time and building wealth on wealth. And so if you get out and it happens to be the wrong time, it's either too early or some other reason it's the wrong time, you can miss out on some of that compounding.
Sure. And it's an act of hubris to think you can time the market. And not only do you have to be right, you have to be right twice, because you have to get out and you have to get back in. And God forbid the market goes back up, you get back in and it goes back down again, and you'll never invest again. So it's very difficult, if not impossible. And so step one is to stay invested. But that leads to step two, because while you have to stay invested, you don't have to invest in any particular thing. Step two is to stay unpopular. And what I mean by that is if an investment idea is incredibly popular, it's generally endorsed by the consensus, and basically the juice has been squeezed out of that investment. The more unpopular an investment idea, the more likely it has already been fully exploited. Instead, I would search for those asset classes or sectors that have not been pushed to extreme valuations. Let me just give you a specific example. So what I'd like to do is pause for a moment here. I look at US equity markets, but you guys have a broader mandate. For example, so I think healthcare is interesting, but Kurt, you and I have talked about other asset classes or other parts of the US market that are also what I would call unpopular.
That's right. So taking that stay unpopular theme and kind of abstracting upward from healthcare, you could certainly look at sectors like healthcare or even individual stocks, but you could also look at market indices of US equities. So you could look at the equal weighted S&P index, where one company has one vote, versus the more popular and more headline market weighted index, where the largest companies have by far more votes. You could look at geographic diversification And in fact, up until recently, we've seen this period of US outperformance versus the rest of the world. And that includes both developed and emerging markets. Historically, though, the returns from international versus US have been relatively similar and prone to significant 10 to 15-year type periods where one outperforms the other. Valuations also happen to be cheaper internationally. And then beyond that, it's absolutely correct that we can look at other asset classes. So we can look at things like fixed income, we can look at what duration risk is being priced at right now, or credit risk. And of course, we can always look at private markets.
Well, and we definitely can do that, and you're the expert there. But Alex, you've done a lot of work in alternative asset classes, and you have a lot to say about what we would call diversification.
So I think a couple important points. One is the reason valuations matter. You mentioned risk, but also return. So if you just look at these markets, when their starting point is very expensive, the long-term returns are actually not very good. So as an example, one data point I look at is the Shiller PE, which takes 10 years of earnings rather than just the last 12 months. So it takes out temporary spikes, so it smooths it out. The Shiller PE ratio goes back to 1860.
Huh.
And if you go back that many years, it's only exceeded 33 times. 1929, it was 33. 2000, it was 44. And today it sits at 39. And what's interesting, if you think about long-term returns, starting in 1929, the S&P averaged 0% for 20 years. Starting in 2000, the S&P averaged 0% for 11 years.
So you're depressing me now, Alex. We've got bad returns ahead. So how can we escape that kind of what I would call a value trap of just doing nothing for years and years?
So what I just described is one market.
Right.
So as Kurt alluded, there's other markets. So when we say the market's expensive, most people think about the S&P 500.
Sure.
But there's international markets, so you can diversify globally. The bond market has yield again. We didn't have yields for a decade. Yields are up again, so that's diversifying. You can look at inflation hedge assets.
Sure.
Commodities, gold. Gold's been on a tear. We can look at inflation-linked bonds that tend to do better when inflation surprises to the upside, and then alternatives. And that's a vast universe.
Sure.
And you can diversify there. And I think what's interesting about diversification today, unlike the way most people think about it, they think of it as you get returns from the S&P, and all the other things are diversifying, but they lower your returns. This is an environment where looking forward, they may actually raise your returns and give you the diversification.
I think that's great. And I think a great way to look at this current market isn't, oh my gosh, it's so expensive, what do I do? It's to think of it, I have this weird analogy, it's like a tidal flow. So clearly capital has come into the market cap weighted S&P 500, driving prices way up. But think about the other side of that, which is that money has come from somewhere. In the S&P, it may have come from healthcare. It may have come from commodities. It may have come from some fixed income instruments, leaving those a little high and dry. So there are opportunities that are actually created by an expensive US equity market that we should try, and that's our job, to try to exploit.
That's right. And I think when we think of portfolios, we see a lot of allocations that are tilted towards the last battle. And in this case, I would define the last battle as 2022, which was a year when international didn't help protect you from a diversification standpoint, and fixed income had a very difficult year. So as a result, the traditional 60-40 portfolio was very challenged. When you combine that with this long-term period of US outperformance, it results in a portfolio that's tilted towards US exposure and typically large or mega cap on the US equity side, and then is shied away from duration and credit risk within a fixed income portfolio. And I think Alex's point about this is the time to diversify is absolutely correct.
And the other thing I would warn folks about is that if you've done nothing, you started out with a diversified portfolio 5 years ago, and you've done nothing to it, and you're happy because your portfolio is diversified, it may not be as diversified as you think anymore, because these mega cap US equities have done so well, they become a disproportionate part of your portfolio. So a rebalancing, the laissez-faire does not work that well in this kind of environment. So you got to make sure you're not now hugely overweighted in, say, the Mag 7.
And I think the other way to think about it is, we talked about valuation, but just look at the world in which we live. There's a lot of risk. There's a lot of geopolitical upheaval. There's a lot of uncertainty about inflation. There's uncertainty about how the Fed's going to respond. We haven't had a recession for a long time. There's one coming. I don't know when, but it's coming. So if you think about that world, do you think of it as I want to be more diversified or less diversified? Most portfolios are less diversified today than they were 10 years ago. They have more stocks.
Right.
They have more U.S. stocks. The U.S. stocks are more concentrated. And so if you look forward for the next 5, 10 years as long-term investors, it seems like it would make sense to be more diversified.
Yeah, absolutely right. And the human nature element of it, you have to push against, because human nature is you want to buy what's working. And while the Mag 7 has taken up so much space in the room, and there's some of those stocks, frankly, all of those stocks are wonderful companies, but I love the saying that there's no company that's so great it can't be ruined by a high enough entry price. So, and I think that there's a danger that that's kind of where we're getting now. So you have to be mindful of not just how good the company is, but how much you're paying.
Chris, and I think you said it, people like to buy what's working, and I would even add to that, people like to buy what has worked, because it feels very comfortable to own these names that have performed really well. They're stellar franchises, but history is replete with examples of the largest company in the index changing over time. We can go back and look at when the oil majors were the largest companies. We can go back and look at the dot-com bubble. We can go all the way back and look at the Nifty 50, and there's just example after example of why you need to stay diversified and why you need to play this long game that allows you to compound your wealth.
And the timing, we're not going to get perfect.
For sure.
But if you're planning for 5 to 10 years, the odds are stacked against strong performance.
Right. So you bring up a good point, Alex, which is to become diversified. But we've also discussed about diversification doesn't mean selling those great companies totally. And look, the U.S. is really in the lead in AI. This is going to be a decade-long thing at least. So it's going to change the world, just like the internet did 30 years ago. So we're not saying get out of that, go into healthcare or anything like that. But what we are saying is reassess your portfolio, make sure those haven't grown to a disproportionate level. And remember, they're expensive, so size them appropriately. So finally, I want to get to the last step in the kind of three-pronged plan to investing in an expensive market. The last step is to stay focused on your plan. Don't let things get you off course. So when you're running a marathon, you have to pace yourself. The current market is being led by sprinters who are racing out front, but no one remembers who was in the lead halfway through the race. Instead, I think the best thing to do is to stay in the race by staying close, but by owning less risky investments, and we've been talking about how to do that. That doesn't mean, again, we avoid the high growth investments like technology, but it does mean we obsess over how much we pay for them. Again, there's no investment that's so good it can't be ruined by high enough entry price. So, as mentioned, while we believe strongly in a future filled with the wonders of technology broadly, and also AI in particular, we want to not pay the high prices for many of the shares of those companies that are currently the stars in those fields. It reminds me too much of the internet bubble, and Kurt, we talked about this. While that technology changed the world, again, when's the last time you went to an airline ticket office, which is, I'm old enough to remember, you may not be. Many of the stars from that time are flamed out. AOL, Netscape, Yahoo, eToys, those all had market caps of over $10 billion, and yet they no longer exist. And the reason I'm bringing that up isn't to say that the current leaders are going to flame out, but is to say there is risk that the folks back then, and believe me, I was managing money then, the folks back then didn't take as seriously as they should have. So when I think about running a race plan, I think about 5 to 10 years. And what do you talk to your clients about?
I agree with that. I think diversification is the tool that lets you follow your race plan. If we go back to that dot-com bubble and we think about some of the iconic names that were created during that time period and have gone on to be some of the best companies in the world, let's look at something like Amazon. In the dot-com bubble, Amazon owners faced over a 90% drawdown. And I would suggest that it's very hard to stick to a plan when you're going through a 90% drawdown if that's not an appropriate portion of your portfolio. And the worst thing that you can do is change your plan mid-race. After spending all this time practicing and all this time preparing and being ready for these scenarios, the emotions are really tough of a 90% drawdown. So again, I would go back to that. Stay diversified, to be that long-term successful investor?
And I think a lot of it has to do with a mindset. You know, my sense is a typical mindset is I'm in the market, I'm out of the market. And that goes back to the market timing.
Sure.
And what we're describing is the mindset is stay invested, stay diversified, understand what it means to be diversified, recognize that it's a world where it makes sense to be diversified, and that makes it actually easier to stick with the plan because you should experience less, massive ups and downs.
Sure, absolutely. And it's interesting, when I think back on those times, and I was a director of research at a firm in the 90s, and we were struggling with how to navigate an expensive market. And so I mentioned AOL and Netscape, and these are companies that really tanked and didn't come back. Yet Amazon is a company that also tanked, but if you had the wherewithal and the intestinal fortitude to invest in it after it had gone down 90%, you would have, basically the winner of your investment career on your hands. So that's our job, which is to separate the wheat from the chaff and figure out which are the Amazons and which are the AOLs. But in any case, in the late 90s, none of them were good investments for that period. So valuation at the end, as we discussed, does matter, and we pay a lot of attention to that. That wraps up our talking shop for today. Again, navigating an expensive market. Stay invested, stay unpopular, and stick with your race plan. So for all of us here at MAI Capital Management, I'd like to thank you for joining us and have a great day.